The focus is now on what's in the portfolio, as history tells us this first bounce off the October lows can be the strongest. Gary Glover is guiding us through the indices and the companies that he's trading this week. Good morning, Gary. How are you?
Yeah, no, I'm good, Chris. How you going?
Well, I'm a little surprised, along with the rest of the market, how much we bounced off the lows, but I can't really say that you're surprised, because this is something that you'd looked at and called out quite some time ago. You loaded the portfolio up, you were pretty much heavily invested. So how's that portfolio looking as we sit today?
Yeah, it still looks better today. Didn't look so good on Friday, but yeah, the last couple of days, obviously, it'll look quite nice there. So I have trimmed a little bit of my AIZ just because I'm way overweight. So I've trimmed some of that back. Got stopped out on MP1, which is a bit of a pain, but yeah, it did sort of. It's funny, I had a big day there, obviously, last week, and then getting caught with MP1 was a bit of annoying there, sort of giving back some of that. And then, yeah, but definitely seen lots of volatility. But the thing about volatility, Chris, is that normally the one thing about vol is that the greatest volatility occurs one of two places, either at the high or at the low. So you normally don't get volatility like that in the middle of a move, you know what I mean? So when you start seeing those sort of big swings up and down, you got to ask yourself, where am I? Where am I? Am I near a high, or am I near a low? So it was a pretty easy.
It seems like a rhetorical question right now.
Yeah, but we were a deep low coming, some big levels technically. But once that volatility starts to spike there, that sort of gives you a clue there. I know it doesn't feels always a bit scary. Definitely felt scary maybe a week or two ago at that, was it October 11 or something, low there or something, which is I think a day away from one of our sort of key timings there that we're looking at. But yeah, everything looks pretty good here now. We're sort of, markets come back to some big technical levels, so come back to like a 61.8 on the Fibonacci for the NASDAQ. I think a 50% retracement for the S&P 500, and come down and taken those lows out. They've all gone to new lows. People looking for this capitulation loans, just that doesn't happen normally. What we've seen there is we've seen extreme bearish sentiment too at those lows as well. So you're talking about sort of sentiment which is historically as bearish as all the past previous big lows. So in terms of sort of which is always sort of, it's just funny, so it just always occurs that way. So when everyone's giving up on the market, everyone's complete agreement that the market's going to go lower, and that's usually the point of the low. So yeah, it always feels scary, but that's when lows do come in. So I just think we got some great technical set up here to me, sort of, as I think I sort of indicated the last week or two there, that all the the technical signals were all basically we're all sort of classic there. It was sort of squaring of ranges, coming back to old highs, Fibonacci levels. We just had a confluence of technical signals telling us that this could be an important low. They're pretty deep too. I mean, 38% correction is pretty big on the NASDAQ. So 27.5 or 28% on the S&P. It's pretty decent as well. So these aren't sort of small corrections. I know sort of maybe with the GFC and stuff that we've gotten used to these big corrections, and also and COVID, but those sort of corrections at sort of 50% or 40%, they're not that common. If you go back and look historically there, I think this will go down as like number 5 or number 6 in terms of size and sort of length there. So that's pretty decent size, So look at this stage, looks still a bit unproven here yet, but I think the signs are pretty good here. I think if we get a bit of follow through this week, which so far the first few days are already sort of showing a bit of strength here. So look, hopefully this will probably be a bit like last year. Chris, might go down as a very unloved bounce here, and it's like the last bull market was where there's some suggestion.
Bull market.
Yeah. Well, this maybe this one might be something similar. Definitely feels like everyone is still bearish here, still negative. Most people don't believe this market can go up. So that'll leave, I'm hoping that'll leave a lot of people behind. and market goes up, and everyone will think, no, it's going to turn, doesn't turn, and all of a sudden we're playing catch up. So fear of missing out, fund managers being underweight, all that sort of stuff. There's just all that classic sort of psychology which comes to the market. So I think the signs are pretty good here early. A nice up week here. We finished pretty strong this week. I think that'll to me will definitely give me some pretty high confidence that the low's in and that we're going to move higher here. And look, we should be sort of running up into early December at the very least, I think.
Well, that's a good point to look for the cycles and that sort of movement. We'll have a look at that in a second on the Dow because you've got a good chart there. But if we have a look at the Aussie, so the ASX 200, we've said for some time that it's value focused. It's got commodities, which we've seen expecting the inflation to cool off as being a bit of a downside. But just this week, Joe Hockey, US ambassador, has come back and said it looks as though Australia could see a large institutional investor that we haven't ever seen before, the US investing in Australian commodity assets. And that sort of helped buoy a few assets this week. Could it be that maybe the Australian market might not be as bad if these kind of factors and events happen?
Yeah, definitely. We've shown a bit of strength here early. I mean, the normal cycle for this sort of midterm year and the seasonal cycle is for commodities to go lower and to drag us a bit deeper, bit further down the chain here. So as I say, like a bit of a broken record here, but normally sort of bonds first and then equity second and commodities third. That's the normal sort of cycle. So historically there we might sort of bounce here, but then commodities will sort of drag us sort of lower there, and they'll find a low a little bit later there, maybe a few months after the US has sort of found the low. That's the normal cycle. But if we are in a high inflationary cycle and that does persist, then commodities could hold up as well, could actually be performing here. So like I still think it's pretty hard to sort of call either way at this stage. I think we need to sort of see what inflation does here and see whether we get any any relief there. I think it will see some relief from inflation, but just whether we see a small amount of relief or a big amount of relief. So as we showed last week, if we look at that sort of chart of the 40s and the chart of the 70s, which are obviously those high inflationary periods, even just getting a reduction in inflation, so just going from 11 to 9 or from 9 till 7 or something like that, that was enough to get markets going and give them a boost. And we can sort of see how big the swings are. Even just a slightly cooling off in high inflation there can really sort of push equities pretty high here. So I think it's a bit early to call here. I just sort of think we'll see how we sort of go on this bounce here. I mean, I actually do hope that commodities do underperform here, Chris, because then that's probably better for the market longer term. That'll show sort of easing in inflation. If inflation remains high, then we go through like a 40s or 70s sort of style, then maybe your commodity stocks will probably stay buoyant and not sort of weaken off there, and then maybe our market will be stronger here. But let's say, like, definitely like Aussie, where the high, if we are going to go through high inflationary period, then you've got value stocks, you got commodities, high dividend stocks. That's really going to be a great market to be in anyway. So, but it sounds funny, but that's the better outcome actually is for inflation to cool, commodities to sort of pull back here. Maybe our market to find a low, maybe early next year, maybe just go slightly lower there. I just sort of thought we'll get a bit of a bounce here, maybe come back, and then the bull market commence after that. And that's the normal pattern there. And that would be the best outcome for everyone. But we'll just have to see what happens to inflation here. So there's definitely, I think it's 50-50 in my opinion. I think inflation's high here. I think there's some risk here that it will stay high for quite a period of time, as in number of years. But if it does start to sort of cool off and come off quite a bit, then that'll be pretty buoyant for equity. So yeah, we'll just have to weigh that up as we come through here in the coming months. That's
a good point to probably move to the Dow, which similar thing you've said, had value and looked at that for some time. We're in the middle of the reporting season in the US at the moment, and this is a smaller index that can move quickly off some selected names having good, strong news. How do you see the Dow sitting at the moment?
Yes, the Dow's obviously been, like, I guess those previous growth crunches there, it hasn't come back nearly as much as the other markets, which is often the case. And and it's shown a bit of strength here as well. It's already sort of bounced pretty strongly. So it didn't really sort of come back to the 50% range. But yeah, we're sort of seeing a bit of relative strength there. But yeah, from a timing point of view, it's been perfect. Now sort of early October low, starting to bounce here. So I think this might actually sort of rally up into early December here. Maybe it'll ease back into sort of February, March, and then we kick on from there. That's the sort of normally bull cycle there. But we'll see how this ventures out here. The thing about these midterm years, Chris, is sometimes people underestimate the rallies that come out of these. Can be phenomenal. So the average rally for the last 2 months of the year is around 20% on the Dow, and the average rally into the from 13.5 months from the October low in the midterm year is around 49%. So there's some big, the cycles are all very, very bullish here. So seasonality sort of cycles, everything else. So it'll just be interesting to see how it happens here. But I think get a rally here in the short term just to see how impulsive this rally does get here, and then see what occurs after that. At this stage, you've probably got to be not too buoyant. You'd think conditions still look a little tender out there. Inflation's still a concern here, so probably favour if you remember sort of the 2002, 2003 period there, coming off that low, similar sort of growth crunch. We saw rates going up there. Didn't have the inflation that we have now, but that had a nice bounce up into December. Then it pulled back into, I think, Feb, March, and then it sort of kicked on from there. If you remember, our market actually found a low in March of 03. So yeah, we'll see how it pans out. Even in the short term, it still looks pretty positive here. So I think the market can rally here. I still think everyone's underweight here. So that's why I think we can get a bit of legs here, because no one thinks it can go higher.
That's what you were talking about, the fear of missing out. Those who, all that cash that's on the sideline just comes in heavily trying to catch up if the market does get away from them. And all those, you'll talk about the puts in a minute, but all those bearish positions that are being added still, if they get turned around, closed out, short squeeze along with the rally, and then reversing those positions. Is that kind of where that speed can come from in these rallies?
Yeah. I actually read a quote this morning, actually, when I was, I think I was reading sort of something on Steve Burns, sort of from, it was sort of, I think it might have been in one of Market Wizard's sort of books, which was sort of not the one on individual traders, but actually on hedge funds. And the quote was, big market price changes happen when lots of people are forced to reevaluate their prejudices. Not necessarily when the world actually changes. So when everyone can get so heavily so negative, or everyone gets in the same camp here, so the world hasn't changed here. Just basically the market just gets all cornered into one area. So it's a bit like sort of BHP and Rio. Sort of remember at the top in I think it was 07 or whenever it was there. Commodities were booming. It was just conditions were just perfect. But the reality is that sort of, when they're $100 and $50 there, everyone was already long. There was no one, there's no one left to, everyone was overweight commodities. Everyone was already in there. So everyone, the good news was as good as it gets. It's just, that's oftentimes sort of when markets change. So you just have to be able to do it. Just got to be careful, sort of being too prejudiced by the market here. The market will steer you and tell you where it's going. I think if you sort of get follow your emotions and stuff, there sometimes you'll get led astray all the time. So it's bizarre. I just I've been following these markets for 20 years now, Chris, and I just see the same things happening year after year. And I just maybe because I'm not the most emotional guy. I'm able to sort of see some sense through there, but I feel like majority of traders, get too emotional and follow their emotions of trading and markets, of sentiment, news and stuff there. That's just not how markets drive. They have a mind of their own at times. So you have to respect that. So.
And if we're looking at the current market, as you were saying, everyone's extremely bearish. So we'll probably loop back to that in a second, actually, because you've got some trading shares and then you've got some good tweets at the bottom that you picked up this week. So of the trading shares, you've gone and picked up a few retail companies in this list. So Adairs, we've seen strength in the retail names despite interest rates rising. You've also noted some travel shares in the last couple of weeks that have rallied and continued higher despite high oil and rising interest rates. What's attracted you to Adairs on this chart?
Yeah, I mean, I think Adairs is sort of obviously had a great move through COVID, got a bit overzealous, and then it's had a massive correction as a sort of as we come out of post-COVID. We're not at home, on the internet buying as much sort of stuff there, but you probably get overbought and then you probably get oversold here. But I mean, the reality is, I think we're back to PE might be around 7, the yield's around 9%. So even if you sort of allow for a haircut in terms of earnings there, still some great value there with Adairs. And I think they've sort of just given an update there that they're traveling pretty well. So I just think there's definitely some value there. And also along our lines, if we do sort of think about, I think these sort of value shares, the sort of companies that they've got some reasonable growth, that the PEs aren't excessive and the yields are pretty high. That's going to be, if inflation does persist, that's going to be where people that's where the market will start positioning here. So I just don't think it's all doom and gloom here. I think everyone's pricing in too much negativity. And just some value there. I just like what I see technically. It's come back a sort of pretty healthy amount here. Sort of come back, make a higher low. I think we just made a second higher low here. So I just think it looks constructive. Hasn't been too much selling on the downside there. So volume profile looks pretty encouraging. So similar to sort of Harvey Norman in a way, probably not as I think Harvey Norman's probably had a milder correction there. Only come back, I think 61.8% of the range. Sort of it's rallied 9 weeks and come back 9 weeks. So remember, sort of McLaren used to, he used to say, trading, it's as simple as counting, count how many days up as to how many days down, and you can sort of work out, whether the stock's got strength or not. So, if we're rallying up 9 weeks and then pulling back 9 weeks and we don't go to a new low, then we're struggling to go down. In this case here, we've come back only less than 2/3 of the range. Volume sort of dried up a little bit there as well. And just leaves it in a pretty strong position. So this is sort of normally where you sort of get a bounce on these points here. So I think if we see a bit of a bounce here, bullish reversal, see some volume coming in here, this is definitely one to follow. And again, there's definitely some value there with Harvey Norman. Again, the PE is low, the yield's high. I know sort of you got to, these earnings can be might be wound back a little bit, but market sometimes can get too bearish and wind them back too far, and then there's some value there. So even though that those earnings mightn't be as spectacular as they were previously, it's still they can get really discounted. So we've seen the banks come back down to the banks didn't get incredibly cheap there recently. Probably came back to sort of probably normal valuations, or just maybe slightly under normal valuations, but they've all bounced as well. So I just think for me, I'll be looking at sort of the safe play at the moment is to look at these sort of more value quality companies with quality earnings, and the PEs aren't too excessive, and the yield's pretty high. I mean, I've bought a bit of growth here, so I'll probably I think the first bounce here, you should probably get a bit of a move in the growth stocks, but I think after that, value is the place to be. So I think it's okay to have a little bit of growth in the portfolio, but I think you want to have be looking at value as well. So things like healthcare, travel. I think the retail stocks are overdone here as well. So there's a few sectors I quite like where there's a bit of value there.
Okay, well, that's probably a good point to look at some other ones that may be offering value. And one that's often overlooked is the ASX with their consistent revenues that come through, but
Yeah.
trading activity does vary a lot. It's had a pretty big hit. So
Yeah.
95
Yeah.
area down to
Yeah.
65.
The thing about this share is too, I mean, like it's it's a really impulsive move down. So that's pretty scary to be stepping in front of that. I mean, I wouldn't suggest stepping in front of that, but you look at the history of the stock. When it sells off, it tends to sell off in a pretty impulsive and pretty scary manner. Look how quickly it bounces too. It doesn't muck around. So you don't get a chance to sort of buy this stock, too often. You only sort of get a chance maybe once every year to sort of buy it, at a pretty reasonable price here. So I quite like it here. I think it's sort of come back to a new low. I think it's actually gone 10 cents below that 2021 low. And if it can hold here and recover here, then it could bounce there. See the volumes are up to the last few weeks. So it could be a sign of accumulation occurring here. So I think it's sort of I just like the signs here. Sort of, I love to see these sort of come back and retest the weekly low, the low from a year or two ago, and go marginally lower and then reverse here. So if this reverses here, you watch, this potential bounce pretty strong here. So definitely sort of one to watch here.
Okay, well, if we move and have a look sort of back into that retail space or more on the travel side, Webjet, you've covered this many times about how that both Webjet and Flight Centre capital raising and how their market caps have changed since COVID. Are we seeing a lot of support on that red line there?
Yeah. So similar to this is actually similar to Flight Centre. I think sort of similar. Although sort of Flight Centre might have sort of broken its sort of maybe its uptrend line, it has there's a key support there, and I think it's around $14.50 or $15 on it. So same here in Webjet. That 460 line is just such a significant support so far. And as I say, there's a lot more shares on issue there, so it was never really going to get away for a while. It's going to take time to sort of build here, start making some money here, and then once they start making some money, either whether they give it back to shareholders or buy back some of the shares or not, which is often quite common. But I think this is pretty constructive here. I think buying sort of close to 460 with a good risk reward setup is probably something I'll look at there if I can buy a little closer to that mark. With a good risk reward setup there, I think it's worth a look here. But definitely like the sector there. Just starting to see all the sort of rhetoric, all the sort of Qantas update was pretty encouraging. Just all the travel news is coming through as we're all aggressively getting out there and traveling again and wanting to travel and booking. So it's pretty encouraging signs there for the travel sector, which has been probably decimated for the last couple of years. So I think this is sort of a sector which will get some positivity here over the next sort of 12 to 18 months there. So definitely a sector I like there.
Okay, well, another one on your list is in agricultural space. So most of Australia has been underwater, under rain, flooding, all up and down. Select Harvest is in that space, but it's also a bit of, you've got an inflation play here as well. So how do you see Select Harvest coming out?
Yeah, it's one I sort of traded before. Can move around a bit here. So I just think this one's not too. I don't think it's sort of too high on the sort of cost curve there as well. It's not like I don't think they're sort of labor intensive there. So don't have some of the issues that sort of Costa have. Obviously, with some cost pressures there, but I think you're able to sort of pass on some of these costs to the consumer in the end. So I just think there's an opportunity here. Just noticed it's had a bit of a bounce there, pull back on pretty light volume there, not too much sort of selling there. So seems to be sort of building a bit of a base here. Sort of, if you look at that, sort of probably go to 0, 1, 2, 3 pattern in there, which is sort of, that's how nice sort of bases get built here. So if we get a bit of a bounce in here, just saw a bit of volume there last week. If we can get going here, this could be, encouraging here. So, the daily's got a nice little VCP on it as well. Nice tight little triangle there. If you can sort of break up out of here, it'd be worth sort of following here. So a little bit early at this stage, but I think that looks pretty encouraging. So I think it has a little pop there. It's definitely one to follow there if we see a bit of volume.
Okay, well, that's a good one to leave on the watch list. Another one that we circle back to the gold space, which just, we'll no doubt we'll look back in history and scratch our heads as to why inflation was running hot and commodities were running hot, but gold was left behind.
Yeah.
No doubt we'll find out in months and years ahead what actually the decision was, what causes that. But what's the attraction on Ramelius for this chart?
Yeah, just like the fact that it's sort of gone to a new low, had a bit of a bounce off there, a bit of volume came in on the last low, then we've sort of pulled back and then the volume's dried up and we went to a new low, didn't follow through, then bounced up the next couple of days, just sort of built a little bit of a, what do you call it, little shelf there, and then just a little bit of volume on Friday there as well. So okay, that looks pretty interesting actually, sort of definitely getting a bit of support here. Just notice a few of these golds, Silver Lake, Newcrest, all looking kind of constructive to me. So US dollar, I think, has probably been one of the biggest drivers of sort of the gold price being negative. So US dollar is actually sort of starting to show some signs of weakness there. And so potentially could see a shift there. So I quite like the sort of golds here. I think there's sort of potentially in play here. I just like this one here. I mean, anything you can sort of buy near the last low there with a tight stop here, good risk reward setup. So probably not the strongest sort of stock on the board in terms of gold, probably kind of weak here, but interesting some of the weaker ones are actually, a little false break here. They're just a little pattern I like here. So if I'm only risking a couple cents to sort of maybe make 15 or 20, it's a good risk reward there. But yeah, just interesting. Just I feel the golds are actually sort of interesting sort of setup here. They're sort of managing sort of hold here. I like the volume profile there. Let me down a couple of times, the gold stock, so definitely treading lightly there, but definitely one I'm watching very, very closely currently.
Okay, and we loop back now to the tweets that you picked up earlier, talking about the Dow puts, bearishness, fear of missing out. So can you talk us through these tweets that caught your eye this week?
Yeah, I just saw it I saw quite a few actually. It's sort of there's a couple of tweets there sort of talking about sort of bearish sentiment. I think it's the AIII sort of pessimism index, and so that's sort of that is up there currently. It's sort of the most pessimistic this market has been here in the last 30 years there. So historically some big turning points there, some big lows generally come in pretty close to those in the past there. And then I think last week we had record amount of puts. Well, that just continued on even at the last day, or obviously this may have been over the weekend there. Even in the face of that one day up, people were putting more puts on. So so again, another record in terms of a number of short positions put on there as well. So that's that's pretty bearish as well. Actually, I saw really interesting another tweet actually might have been yesterday from at Callum Thomas does a lot of like a lot of charts. Actually, some really good charts. He's actually really worth following because he has a really good chart there. But he had a chart there from J Kappa, which is sort of one of the sort of seasonal guys there, and he was talking about I think it was like a industry percentage versus sort of index, but it was just sort of, again, it's another sort of pessimism, excessive pessimism sort of index. And it was just pretty interesting there, sort of looking at how low this pessimism how high this pessimism index is at. If you look at the historical pattern now, I think 1 year later, 100% success rate of like a 27, 28% return from every hit there in terms. So you get a bit of short-term weather. So I think the month or two, you can be sort of flat or or only small, but then within a few months it starts to sort of go up here. And I think it's only sort of 62% up, I think, within 1 month. It might have been 67% up within 3 months, and then 91% up within 6 months, and then 100% up a year later. So just tells you when you sort of get readings like this, they're sort of they're historically sort of big, pessimistic
Turning
sort
points.
of lows. Yeah, so you might sort of drag her on maybe a little bit further, but you're not too far away here. So, but yeah, it's just interesting here, sort of just how negative everyone still is. Even on this bounce, everyone still see a lot of charts here. So, a few people starting to turn a little bit positive, but I still feel like we're behind the curve here. So, but that's exciting as well. I think by the time everyone starts to sort of believe in this rally, Chris, and everyone starts to get involved, that'll be the time to start shaving it back and start reducing exposure. So hopefully we're a month away from that.
Well, it's whether it's the opportunity now to load up, which you've already done and adjusting, or we get another retest, but that just seems less and less likely as the time goes on, doesn't it?
Yeah, the signs look pretty good there so far. So yeah, it'd just be sort of what happened, just really, I guess, the inflation and commodities and stuff there. I mean, the only observation I have seen so far is that the NASDAQ has sort of been underperforming the other indices, which is sort of typical of a high inflationary environment. So so that probably leans on the bearish sort of side, inflation persisting for a while scenario. But again, a little early to sort of call that. But yeah, that's the only negative there. But the beauty is there, as we sort of showed there last week, in those 40s and 70s, the first bounce we get is normally big, and then after the markets sort of settle down, and then they get a bit tricky after that. So hopefully we'll get a nice bounce here, and then the trickier phase will sort of come post that.
Well, no doubt we'll be turning to you for insights and guidance along how you're reading those charts. So we thank you again for this week's insights from Gary Glover from Novus Capital.
Thanks, Chris.
To see what Gary was talking about on the springs and those trading strategies, the false breaks, the volatility contraction patterns, click on the right-hand side. There's a whole series of playlists that go through trading strategies, and then also looking at momentum shares to see where the next leaders are coming from. Gary goes through those on Fridays.